On a September afternoon in 2016, two men sit down across from each other in a hotel suite in Tokyo. One is 59 years old, a Japanese billionaire, the richest technology investor in Asia. The other is 31 years old, the Deputy Crown Prince of Saudi Arabia, the man who has just been handed control of the largest sovereign wealth fund on Earth. In exactly 45 minutes, they will shake hands. In those 45 minutes, $45 billion will change hands. It will be the fastest fundraise in the history of finance. $1 billion a minute. The largest single sum any private investor has ever raised, anywhere, ever. It will fund the most spectacular collapse in the history of venture capital. It will be tied, indirectly, to a murder in an Istanbul consulate. It will lose more money than any single technology bet has ever lost, anywhere in the world. It will reshape Silicon Valley. This is the story of those 45 minutes and the 10 years that followed them. The room is on the 30th floor of a Tokyo hotel. It overlooks Roppongi. The blinds are drawn halfway. There is a single bottle of mineral water on the table, untouched. The man in the navy suit is named Masayoshi Son. The man in the white thobe is named Mohammed bin Salman. Neither of them is supposed to be here, in this configuration, on this day. Mohammed bin Salman is in Japan officially because he is on a state visit. He is 31 years old. He has been the Deputy Crown Prince of Saudi Arabia for 18 months. His father has just given him control of the Public Investment Fund, the sovereign wealth vehicle that holds the kingdom's oil money. The fund has roughly $400 billion on its balance sheet. The prince has been told to find places to put it. Masayoshi Son is in this room because 3 weeks earlier, he called the prince's office and asked for 60 minutes. He was given 45. To understand why a Japanese investor is asking a Saudi prince for tens of billions of dollars, and why the prince is even taking the meeting, you need to understand who Masayoshi Son is. He is not a typical Japanese executive. He was born in 1957 in a tin-roofed shack at the edge of a railroad track on the island of Kyushu. His family is ethnically Korean. In post-war Japan, that means his classmates threw rocks at him. He would later write that as a child, he thought about killing himself. At 16, he flew to California, alone, and finished 4 years of high school in 3 weeks. He sold a pocket translator to Sharp Electronics for $1 million before he was 24. He went back to Japan, started a software company called SoftBank, and by the year 2000, he was, for a brief moment, richer than Bill Gates. Then the dot-com bubble burst. SoftBank stock fell 99%. Son lost $70 billion of personal net worth in 6 months. At the time, the largest sum any human being had ever lost in financial markets. Most investors would have quit. Son built himself back up, and he learned from that crash one thing that would define the rest of his life. He learned that one bet, one single bet, can pay for every other mistake you will ever make. He is here, in this room, in 2016, because he wants to make 20 more of those bets. And to do that, he needs $100 billion in a single pile. The clock ticks past 3 minutes. At the 6-minute mark, Son makes his first move. He opens the folder. He slides one piece of paper across the polished table toward the prince. On the paper is a chart. It is a single graph showing what Son believes will happen to the global technology industry over the next 10 years. That gap, that $9 trillion, Son says, will be created by perhaps 50 companies. Most of them do not yet exist. He believes he can identify them before anyone else. And he believes this because of one phone call he took 17 years earlier. In October of 1999, Son flew to Beijing for what was essentially a speed dating event for Chinese entrepreneurs. The format was simple. Each founder got 6 minutes to pitch. One of the founders was a 35-year-old former English teacher. He didn't have a business plan. He didn't have revenue. What he had was a website that was supposed to help Chinese factories sell goods to foreign buyers. His name was Jack Ma. His company was called Alibaba. Son interrupted Ma's pitch after a few minutes. He'd already decided. He offered Ma $20 million. Ma said no. He'd only asked for 5. Son insisted on giving him 20. 15 years later, when Alibaba went public on the New York Stock Exchange, that $20 million had become a stake worth approximately $75 billion. By 2018, SoftBank's 27% share of Alibaba would be worth $132 billion. It was, and remains, the single most lucrative venture capital investment in modern financial history. That one bet, 6 minutes in a room, defined the next 20 years of Son's life. He spent every day after it trying to find the next Jack Ma, and he believes, sitting across from Mohammed bin Salman in this Tokyo hotel suite in September 2016, that he has finally figured out how to do it. You don't find the next Jack Ma by waiting for him. You buy every promising entrepreneur on the planet, all at once, and force one of them to become the next Jack Ma. The problem is, that strategy costs $100 billion. The man with that kind of money, the only man who can give it to him in a single check, is sitting 8 feet across the table. At the 15-minute mark, something subtle shifts in the room. The prince has not asked a question. He has not interrupted. He has not, by any of the body language signals that bankers and deal makers obsess over, indicated that he is interested. He is, in fact, listening for a very specific reason. A reason Son does not entirely understand. 18 months before this meeting, Mohammed bin Salman was a relative unknown. He was the king's son, but he was the king's 6th son. He was not in line for the throne. He had no foreign policy experience. He had never run a company. In January of 2015, his father became king. Within months, the new king began removing rivals from power. Within a year, MBS, as he came to be known, had been promoted to deputy crown prince and given control of the kingdom's economic portfolio. And his economic portfolio had a problem. The price of oil had collapsed. From over $100 a barrel in mid-2014 to below $30 in early 2016. Saudi Arabia's entire national budget, every road, every school, every salary, depended on oil revenue. If the price stayed low, the kingdom would burn through its reserves in 5 years. MBS announced a plan. He called it Vision 2030. It promised to wean Saudi Arabia off oil, to diversify into technology, tourism, entertainment, to turn the kingdom into a modern economy. But Vision 2030 had a small problem. Saudi Arabia had no technology industry, no Silicon Valley, no founders, no engineers, no startups. So when a 59-year-old Japanese investor called the prince's office and said he could put $100 billion of Saudi money into the world's most promising technology companies in California, Beijing, Tel Aviv, Bangalore, and that he could do it all under one roof, under one command, with the prince's name attached, MBS took the meeting. What Son does not yet know, sitting in this room, is that the prince has already decided to write the check. The only question is how big. At minute 20, the prince finally speaks. He asks one question. He asks, how much can you actually deploy in a single year? Son answers without hesitation. He says, more than the entire global venture capital industry combined. The prince does not react. The clock ticks to 23 minutes. At the 23-minute mark, Son pulls out a second piece of paper. This one is not a chart. It is the architecture of the fund itself. The Saudi money will come in as preferred shares, a kind of bond. paying the prince a guaranteed 7% annual interest regardless of how the fund performs. This is the seed of everything that will go wrong. A guaranteed 7% means the fund cannot be patient. It cannot sit on cash. It cannot wait 10 years for the next Jack Ma to appear. It has to write checks, constantly, aggressively, faster than any fund in history. Because every day the money sits idle, it costs 7% a year. The 7% coupon is a clock. It starts ticking the moment the prince signs. It does not stop for 10 years. It will force Son to fund a co-working company on an iPad in the back of a car, to write checks to dog-walking apps and pizza-making robot trucks, to lose more money than any technology investor in modern history. None of that is visible yet. The prince says, "How much do you need?" Son says, $100 billion. The prince says, "I can do $45 billion. The clock ticks to minute 32. At minute 45, they shake hands. Mohammed bin Salman would later tell Bloomberg, openly and on the record, "I gave him $45 billion in 45 minutes. $1 billion a minute. The fastest commitment of capital in the history of finance." The SoftBank Vision Fund closes 7 months later, in May of 2017, with $100 billion in total commitments. $45 billion from Saudi Arabia, $15 billion from Abu Dhabi, $28 billion from SoftBank itself, the rest from Apple, Foxconn, Qualcomm, Sharp. It is bigger than every other venture capital fund on the planet, combined. And the clock, the 7% coupon clock that started ticking the moment the prince signed, begins to tick. Within 3 months of closing, Son is in New York. He takes a 12-minute meeting with a 37-year-old CEO named Adam Neumann. Neumann's company rents office space. Son hands him $4 billion on the spot, drawn up on an iPad in the back of a car in Manhattan traffic. Over the next 3 years, Son will pour more than $18 billion of SoftBank money into that one company. $9 billion to Uber, $3.5 billion to Didi in China, $1.5 billion to Grab in Southeast Asia, $2 billion to Ola in India, hundreds of millions to Wag, a dog-walking app, $200 million to Brandless, a company that sells $3 olive oil, hundreds of millions to Zoom, a startup that bakes pizzas in autonomous robot trucks, almost $1 billion to OneWeb, a satellite company. By 2019, the Vision Fund has deployed $70 billion in less than 3 years, a pace of investment that has no precedent in human history. Son is not just writing checks, he is operating. He pushes his companies to grow faster than they can handle. He gives Uber money, then gives the same money to Didi, a direct competitor. He calls his thesis the cluster of number ones. Pick the winner in every category. Connect them all into a single ecosystem. Control the entire technology stack of human life. There is just one problem with the thesis. Most of his picks aren't actually winning. And in August of 2019, exactly 3 years after the handshake in the Tokyo hotel suite, the cracks become visible. On August 14, 2019, WeWork, the company Son funded on an iPad, files paperwork to go public on the New York Stock Exchange. The filing is called an S-1. It is the moment a private company has to disclose for the first time exactly what is inside it. What is inside WeWork turns out to be a horror show. WeWork had lost $904 million in just the first 6 months of 2019. It burned through $1.6 billion the year before. Its CEO had personally bought buildings, then leased them back to his own company. He had trademarked the word "we" and then sold that trademark to his own company for nearly $6 million. He was flying around in a private jet bought with company money. The voting structure gave him near total control even after going public. Wall Street looks at the filing. Wall Street laughs. Within days, the company Son, valued at $47 billion, is being publicly valued by investors at $10 billion, then $8, then $5. On September 24th, the CEO resigns. On September 30th, exactly 6 weeks after the filing, WeWork withdraws the IPO entirely. The company is running out of cash. There is only one investor in the world large enough to save it: Masayoshi Son. It is the most public, most expensive course correction in venture capital history. But the WeWork disaster is not isolated. By 2020, Uber's stock has collapsed. Didi is in a regulatory war with Beijing. OneWeb has gone bankrupt. Wag, the dog walking app, has shut down. Brandless has shut down. Zoom, the pizza robot truck company, has fired most of its staff and pivoted to selling biodegradable straws. And then, in October of 2018, something else happens. Something that begins to make the $45 billion raised in 45 minutes look very, very different. A Saudi journalist named Jamal Khashoggi, who has been writing critical columns about the deputy crown prince for the Washington Post, walks into the Saudi consulate in Istanbul. He never walks out. Multiple intelligence agencies, including the CIA, will later conclude that he was murdered by a team that included men close to Mohammed bin Salman himself. The 45 minutes in Tokyo, 2 years earlier, suddenly look different. Not because anything has changed about what happened in that room, but because what happened in that room is now connected, by name and by money, to a body in a consulate. Son is asked at a press conference how he feels. He pauses for a long time. Then he says, in his own words, that the murder is horrible, but that he cannot turn his back on the Saudi people. The Vision Fund keeps its anchor investor, but the easy money days are over. In May of 2022, Masayoshi Son walks onto a stage in Tokyo to deliver SoftBank's earnings results. He is 64 years old. He looks tired. He announces that the Vision Fund has just posted a loss of $20.5 billion in a single fiscal year, the worst result by far in the firm's history. He says he is, in his own word, embarrassed. He says he is switching the company to defense mode. He says he has been intoxicated by his earlier successes. 12 months later, in May of 2023, he returns to the same stage, and he announces a fresh loss: $32 billion in a single year. It is the largest annual loss any technology investor has ever reported anywhere in the world. The Vision Fund has now lost $53 billion in just 2 consecutive years. WeWork, the company funded on an iPad, formally files for bankruptcy on November 6, 2023. SoftBank's total investment in WeWork, somewhere between $16 and $18 billion over 6 years, is almost entirely wiped out. But there is something even worse hiding inside the numbers. In 2019, while Son was busy lighting other money on fire, he quietly sold off SoftBank's entire stake in another company, a California chipmaker that had been working on something called graphics processing units. The company was called Nvidia. The sale was worth about $3.5 billion to SoftBank at the time. If Son had simply held those shares, done nothing, they would have been worth, by 2024, more than $160 billion. It is the largest opportunity cost ever recorded against a single sell decision. He had bet against the one company that would, 4 years later, become the most important company on earth. He did not know any of this in that room 7 years earlier. He could not have. The $45 billion he had just raised in 45 minutes would, in less than a decade, vaporize an amount of capital equivalent to the entire annual GDP of New Zealand. But here is the part of the story that hasn't been written yet. In 2023, while the world was still adding up his losses, Masayoshi Son walked into another room, this time in Washington, D.C. He sat down with the incoming American president, and he committed, again in a single meeting, $100 billion to a new venture. This time, it wasn't a venture capital fund. It was called Stargate, a joint project with OpenAI, Oracle, and the US government to build the physical infrastructure of artificial intelligence, the largest private investment in American infrastructure in history. Son called it the most important project of this era, and once again, the money came fast. Within weeks, the commitment had grown to $500 billion over 4 years. He had not changed. He still believed he could see the future before anyone else. He still believed the next Jack Ma was out there, except this time, it wasn't a person. It was a technology. It was artificial intelligence. The Alibaba bet took 6 minutes. The Vision Fund bet took 45 minutes. The Stargate bet may define the next 45 years. Whether Masayoshi Son is a visionary or a gambler, whether his legacy will be Alibaba or WeWork, Nvidia or Stargate, depends entirely on what happens next. The clock is ticking. The clock is still ticking. If this story made you think, subscribe. We go deeper into the stories behind the world's biggest business empires every Friday.